President Trump is moving to calm energy markets, asking Israel and Iran to stop attacking oil and gas facilities after the two countries traded strikes on key assets in the Middle East, sending prices soaring. Live from Singapore, this is Insight with Haslinda Amin, where we'll dive deeper into the ramifications for the global economy as this conflict intensifies.
The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them but have no conviction. This is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know.
Fed Chair Jerome Powell says the Middle East conflict has added fresh uncertainty to the inflation outlook as global central banks, including the BOJ, now fretting about rising oil prices. Nomura's head of Wholesale, Willcox, and Jefferies' global head of equity strategy, Chris Wood, will share their views on the biggest risks for the markets. And we hear from Asian businesses that could face the brunt of an energy crisis. We have the CEOs of Thai gig economy startup Lineman Wongnai and Indian game maker Nazara Technologies. Our top story today, growing turmoil in the global energy sector after Iran and Israel traded strikes on key natural gas facilities in the Middle East. Among the hardest hit was Qatar's Ras Laffan industrial city, which houses the world's largest LNG export plant. The escalating conflict is rattling financial markets and drawing the close attention of central banks as they weigh the risks to energy supply and economic stability. For more, we're joined by Bloomberg's Avril Hong, Horizon's Middle East and Africa anchor Jumana Basachi, and the Asia Trade core anchor Sharian. Avril, let's start with you. How are markets reacting? We have week 3 to the war in Iran, and of course Brent in excess of $100 a barrel.
Yeah, we're sitting at around 110, but I think for traders, they're really watching out to assess the damage on Ras Laffan, as you say, the industrial complex in Qatar, which houses the world's largest LNG plant. You're hearing from Trump suggesting some form of de-escalation, but traders are wondering the extent in which the damage has already been done. There's a widening of the scope with Israel and Iran trading strikes on energy facilities. Do you mean to say that, the gloves are off in a sense, as energy facilities weren't quite targeted in this manner previously? So as we watch to see the assessment of the damage at Ras Laffan, you're already seeing since the conflict began, look at the way Europe gas contracts have surged, 70-80%, Asia as well. And for the moment, as we wait for Europe gas traders to come online, we are seeing the Japan, the Korea LNG benchmark already showing that climb. The worry is that even if the strait reopens, that there's more permanent damage to facility. That could mean production will take months to come back online. That's on gas. You take a look at Brent as well. As you said, Brent is above $100 as it stayed there for much of this week. And it's also important to note the spread between Brent and WTI. That has also climbed. So that says a lot about what traders think the impact on Asia, the problems that could arise, are going to be.
And of course, Jumana, this war intensifying, both sides now attacking energy facilities. How much damage has there been? And what does it say about the course of this war?
I think it's fair to say it's day 20 of the war, Haslinda, and we have entered into yet another new phase, a very dangerous phase of escalation at this point. We suspected that the retaliation from Iran after Israel hit the South gas fields would come overnight. And indeed, that is exactly what happened. They have lashed out at multiple countries in the Gulf. Most specifically, the one that's getting a lot of attention is that Ras Laffan energy facility. And we've we've just got more information in the last hour. Qatar LNG putting out another statement saying that their LNG facilities, so initially the damage was sustained at their gas to liquid facilities, but they've also now said that their LNG facilities have been susceptible to extensive damage as well. The fire has been put out and contained. Fire has been contained, they say, but at this point, unclear exactly what that extensive damage means and how long it might take in the future for these operations to be up and running. So you've had strikes on Qatar LNG. You've had strikes on 2 gas fields in the UAE as well, which has led to halted production. And you've had strikes on refineries outside Riyadh to also shrapnel from debris causing a little bit of damage there too, which means that production has been halted there. So a series of responses. And you just need to look at the words and the statements that are coming through from various foreign ministries. The Qatar Foreign Affairs Ministry put out several posts overnight, essentially condemning these attacks, saying that they are blatant aggressions. Qatar has crossed a red line. And Saudi Arabia Foreign Ministry going one step further and saying that this is an extremely dangerous point of escalation, and Saudi Arabia would not hesitate to respond either politically or, quote, non-politically as well, that Iran should not underestimate the ability of the Gulf states to respond. So for all intents and purposes, a deep escalation from the part of Gulf states as well. And then President Trump, you just referenced this post, of course, that just came through. He was claiming that the U.S. had no prior notice that Israel were going to attack those South gas parts fields. Also said that they will not attack again, but that if Iran continues to retaliate against Qatar, then the U.S. would have to get involved and strike out back at the South gas parts field as well. So the market is reading this as an attempt to de-escalate. But of course, at this juncture, tension is running very, very high. And the damage, the physical damage, is one that's still being assessed and could actually have implications, not just for months, but for years to come.
And of course, Sherry, central banks around the world are keeping a close eye on developments in the Middle East. The BOJ stood pat today. How much is the rise in oil prices being factored in by the BOJ?
The situation in the Middle East and higher oil prices very prominent in the BOJ statement. The BOJ kept the rate steady, as you said, as expected by all economists surveyed by Bloomberg. But those comments around the price of oil, that they would be leading to inflationary pressures, was very key. Of course, inflation has stayed above the BOJ's 2% target for more than 4 years already. And oil is a huge risk for this economy. We're talking about Middle Eastern oil accounting for more than 90% of oil imports for Japan. And we're not just talking about oil, we're talking about petroleum byproducts like naphtha, for example, the bulk coming from the Middle East. All of this could lead to the trade deficit widening here in Japan, putting more pressure on the Japanese yen. That's another key risk that policymakers here in Japan are watching. And we have seen Finance Minister Katayama already talk about how higher oil prices are affecting currency trends. This could be a key risk for the BOJ that's standing pat despite the fact that we're seeing a stronger wage growth momentum across the country. We are now seeing the yen hovering towards that 160 level. Not a big impact coming from this decision today that was pretty much expected. But what we'll be watching, of course, is Governor Ueda's press conference in just a few hours. What I'm especially curious about is also what will be said between Prime Minister Takaichi and President Trump at that summit tonight in Washington, D.C. That's the first time that Prime Minister Takaichi goes in an official visit to the U.S. since taking office in October. We know that President Trump is very much distracted with what's happening in Iran, and he doesn't necessarily always follow macroeconomic trends. And in the past, he's made a lot of comments about the weakness of the Japanese yen.
Bloomberg's Avril Hong, Horizons Middle East and Africa anchor Joanna Versace, and of course, the Asia Trade co-anchor Sherry Ann. We thank you so much for that. Let's discuss market dynamics amid the Iran war with Christopher Willcox. He's Nomura's head of wholesale and chairman of investment management, and was also recently appointed a deputy president at the Japanese bank. Good to have you with us. We heard about what the BOJ did, stood pat. Is it under a lot of pressure now to move in April? inevitable to move in April?
Yeah, I don't think there's any surprise. I think central banks all over the world are being presented with some really challenging trade-offs, but in terms of growth, inflation, and I think Japan has had its monetary policy on a normalization path anyway, so we've been expecting to see them raising rates this year. This is an additional data point that's very difficult for them. I think most likely we already expected them to go in April. I think it makes it more likely that the April hike will come through, yeah.
Will that support the currency now? Currently trading 159.64, inching ever closer to 160. Can that move support the currency?
Yeah, look, a lot of people think the 160 level is an important level. I think we sort of think if we start seeing 162 and those types of levels trading, it's not at all impossible that you'll see the BOJ taking some form of action. And it has to feed into the monetary policy decision as well.
Well, the thing is, Katayama came out to say they'll do their utmost to ensure that the currency is supported. We have a dollar that is rising by the day, really, really resilient. Can the BOJ do one and be done?
I think the level of uncertainty around what's going on in the world today means it's pretty hard to predict. But for sure, the currency level is a sensitive thing for Japan. And it feeds into some of the inflationary concerns that existed before you had any of the Middle Eastern events.
So what do you do with Japanese assets right now? Do you sell the yen and sell the JGBs?
I think it's like every other asset class in the world. You're faced with a lot of uncertainty, and a lot of it's going to boil down to how long the current series of events continues to go on for.
What are you advising clients to do with Japanese assets?
We would be advising them to, so we think the medium-term trends in Japan are very positive. We think ultimately things like equity markets are ultimately driven by earnings potential of the companies in those indexes. So, what's happening right now doesn't necessarily materially affect those things. In Japan, a lot of the reasons why people are positive about Japan markets are to do with domestic structural changes, governance changes, shareholder value changes. None of those things are impacted currently. But of course, ultimately, like every other economy in the world, if you see the feed through from what's happening in energy prices feeding into the real economy and to real earnings potential, then obviously that will have valuation impacts.
So having said that, is Katayama right in saying that the yen level is not reflective of the fundamentals of the country?
I would agree with that, yes.
What would you be most concerned about when it comes to the Japanese economy?
I think, what we have to be most concerned about is that, like many parts of Asia, Japan is very vulnerable to supply from the Middle East in terms of energy and of course, overall energy prices, because they're a big net importer, and you can see that having an effect on inflation. And, this is the conundrum that faces a lot of central banks is, to what degree do you look at this as a short-term shock that you should look through? And historically, central banks have liked to look through energy shocks with a view that they're not actually impacting core inflation. But of course, all of them also had a bad experience through the pandemic where they took that view, and then inflationary expectations did manage to get somewhat out of control. And so I think you see it with both the BOJ and the Fed and all central banks right now trying to gauge the short-term versus long-term impacts.
And that is just it. The Fed stood pat saying that perhaps the energy shock is transitory. But take a look at where oil prices are right now. They've been elevated in excess of $100 a barrel for way longer than people anticipated. Surely that will filter through into inflation.
Well, I don't know what people anticipated, because I don't think we anticipated.
Well, it was meant to be a 4 to 5 week war, and here we are in week 3 with no off-ramp in sight.
Well, yeah, but 4 weeks ago I didn't think there was going to be a 4 to 5 week war. I didn't think there was necessarily going to be a war. So I think that's new information, and that's a very short period of time for people to make decisions. I don't think I've seen a central bank governor like Jerome Powell essentially stand up and say as clearly as he did that he doesn't know what's going to happen. I think if you dig into the FOMC minutes, one of the things that's interesting is deeper in the documents, they tend to ask the voting members what they see as the risks to their outlook. And 16 out of 19 said that a rise in unemployment was one of the risks they saw to their outlook. But also 16 out of 19 said that they saw a rise in inflation as being a risk to their outlook. So, I mean, that tells you that there's a tremendous amount of uncertainty really across all of the range of opinions on the FOMC. And I think that's going to be highly reflective of every central bank around the world.
What do you do with U.S. assets right now?
Well, I think our outlook for U.S. assets is positive. Obviously markets have been somewhat well valued, but we don't see that they're absolutely stretched. I think some of the big themes that people were talking about before the Iran conflict are still in place. It feels to us like earnings potential is very strong. Obviously, there are question marks around, or there had been question marks until we spent our whole time focused on the Middle East around the AI trade. But broadly speaking, we were constructive and positive about the US economy. And the US, if we look at what the winners and losers of an energy price shock are, the US is probably on that list of countries that's more of a winner, given it's a net exporter of energy. So for now, I don't see a major sort of negative change to the outlook in the US, which was broadly pretty positive across the industry.
The US may be an energy exporter, but it does get translated into higher gas prices, higher prices at the pump. And some are suggesting that perhaps if oil prices remain elevated for a very long time, we could see stagflation seeping through.
Well, I think this is always a question for energy producers, and you see the same thing in Asia with Malaysia and Indonesia, that you can be a net beneficiary of higher oil prices and still have a domestic challenge in terms of impact on consumers. And you often see some of these countries putting fiscal policies in place, including energy subsidies in their domestic economies to cushion the impact on the domestic economy. In the US, in a sense, I don't think that there's any net impact. If anything, it could even be a positive net impact on GDP or the overall growth of the economy. But there would be pain felt by consumers, and that turns into, for sure, a political question as well.
Well, I guess my question is really how confident can you be when it's still a moving target and oil prices are so elevated? In terms of the Iran war, what impact has it had on your business, the wholesale business, the trading business? What are you seeing?
Well, you can imagine that the first priority for us is focusing on our clients and also on our employees, and we have a number of employees in the region, so we have to make sure that they are safe. We also have to make sure that our business operations have resilience and are continuing, which we've spent a lot of work on over the last couple of weeks, and we're very comfortable with. And then, our clients need us to be there for them. So the answer is a bit boring, which is that we're really making sure that operationally that we're solid, that we have all of the contingency plans that we have in place. The second order effect, obviously, is what are the things that our clients need us to do for them, and our clients need our sort of execution and advisory capabilities more than ever when you have this much uncertainty around. And so we're very focused on clients right now. But in
terms of business per se, what are you seeing? From
the perspective of business, we haven't seen a major impact, and at the moment we're not perceiving that to be the case. To some degree, the volatility in markets provides hedging needs from clients. That obviously is business that we do, and so we see some increased volumes of business. Like the central banks, we're in the same boat, which is the longer the situation persists, the more impactful it's likely to be on our business. So if this persists for months and months and months, yes, you will start to see this roil into the banking markets, M&A transactions, delayed decision making. But right now we don't see anything that's super material in the short run. But we're going to have to watch it carefully. And then what's
the time frame that you're looking at? If this war goes on for 6 months, 4 months, that you would see a material impact? Is there a way of quantifying the kind of impact that you're looking at?
Yeah, I mean, look, as I say, the longer it goes on, the more the second order effects are going to be. Some of those second order effects are pretty unpredictable. I would say that if we have a conflict that continues on for, let's say, another 3 months, you're going to start to see some of those things really manifesting themselves in as much as they start to impact into supply chains, and we've seen that before. So, the other thing that we spend a lot of time on in this is scenario analysis in terms of risk, because again, if this continues on for a longer period of time, the second order effects that could occur in terms of, obviously we've already talked about monetary policy, but then into asset class prices, credit, etc., are things that we have to be prepared for. So we spend also a lot of time looking through our portfolios, also working with clients on their portfolios to try and make sure that we've got the appropriate hedges in place and that we don't have exposures that are either not well understood or that potentially have second order effects that could impact them.
You talked about how if the war extends to about 3 to 4 months, that would have longer term implications. Which of the businesses would get impacted first?
Well, I think if I could tell you the answer to that, I'd obviously be a wealthy man. But yeah, I mean, I think what you have is on the sort of investment banking side, you've obviously got deals where, in terms of the due diligence that people are doing in order to do transactions, your ability to do that due diligence and understand what the forward earning profile of the business that you're buying or selling is becomes a lot more difficult. So those transactions are more likely to be delayed. It may also be the case that the people who are looking to invest become more risk averse. So that can be something that slows down deal making as well. But then in equity markets, like I said before, what you're really going to be looking for is things that tell you that there's a real change in the earnings potential of the companies, and that's really in the long run what drives the share price. I mean, I think you've done this for a long time, and I'm sure that you'll remember that any number of times over the last 20 plus years, we've sat here and the biggest single story is a geopolitical story, and a year later we're not talking about it at all, and some of those stories are really big. So I think it's pretty unpredictable, and you've got to look at scenario analysis across a range of different outcomes. Clearly we're seeing monetary policy impacts. Clearly that will translate into the fixed income market as well. Whether this translates into something that has direct impact into credit markets will be one of the signs of some form of contagion from it.
When it comes to the credit market, what's your own assessment of whether or not there'll be contagion at this point in time?
Well, even before any of this arose, that we were seeing some cracks in private markets. So I think generally speaking, the market would say that we're closer to the end of this credit cycle than the beginning. Having said that, most of the incidents we saw looked like pretty idiosyncratic events. So it was far from clear that there was any real underlying stress. The good news, I would say, is that from the perspective of the financial system and banks, you start from a position of strength. That's also in some ways the good news around the energy shock more broadly on a macro basis. Asia's certainly very impacted by an energy shock, but Asia's starting point is quite strong. Government receipts and indebtedness and stuff are in good positions. So I think the same is true for the financial system. So I think I don't see something that's going to very, very quickly turn into some sort of crisis, but I think people like ourselves are going to be very cautiously risk managing their positions and looking through exposures and making sure that we
we're not really looking at a crisis, but we have mini crises, right? I mean, right now we have the war in Iran, oil prices in excess of $100 a barrel. We have, the credit space as well, seeing a lot of questions there. Is there a sense, like you said, we've been in the business for a while now, is there a sense that we're kind of like looking at the same situation in the lead up to 2008? Is there anything there that suggests we could be having a similar situation?
I don't think there is, actually, and that's not to say that the things that we're facing aren't quite serious and can have pretty wide-ranging impacts. But I don't see anything that would suggest to us that we're headed into that. Now, having said that, most of these crises tend to be somewhat unanticipated, and so I think if you're a prudent risk manager, you are going to be looking through all the aspects of your portfolio and looking for where you think the pressure might be, and thinking through what the second order effects are. If you remember the pandemic, for example, the effects were not necessarily coming directly from the places that we thought they were going to come from. It was a supply chain shock that turned out to be the biggest disruptor for a lot of businesses rather than the first order effects. But no, I don't see anything that says that we're on the cusp of a crisis. What I see is that we actually we've got pretty constructive, positive outlook economically, both in Asia, in the US, and even in Europe, which has been a place that people haven't been as optimistic about in recent years. I think that, and I think that what we've seen so far is not enough to change that. But yes, everybody's on an amber alert rather than a red alert, watching how this impacts us.
Of course, amber to red can come really quickly. Just before we let you go, the businesses that you oversee are doing really well. Wholesale, in particular, is having a stellar year. In fact, set for, I think, record revenue for 2025. Are you done with restructuring? Are you happy with where you are? Are you looking at further efficiencies?
Well, I mean, we haven't been restructuring. We did a lot of restructuring. I wouldn't say that the last sort of 18 months have been a period of restructuring. They've been a period where all the changes that we made have started to pay off, and we've been monetizing the investments that we made in the business and the investments we made in people. No, we're not especially looking for efficiencies any more than any business always has to constantly pay attention to its cost base and make sure that it's running efficiently. And I think, the opportunities for our business now are, better than they've ever been because of the work that we've done. I think one of the things that's really shown up, though, is that this sort of sequence of external events has shown us that you want to have a diversified business, and Chris, so the investments we've made are paying off for that reason.
Thank you. We have to go. Christopher Willcox of Nomura. Plenty more ahead. This is Bloomberg. Welcome back. You're watching Insight. As traders wait to see the extent of the damage at Qatar's Ras Laffan facility, let's take a closer look at Asia's exposure to LNG from the Gulf state. Avril Hong is back with more. Avril.
Yeah, Has, we've been talking a lot about how Asian economies are vulnerable to what's coming out of the Middle East in terms of energy supplies. For the likes of China, Japan, South Korea, it's worth noting that these were the top destinations for Qatari LNG last year. And a lot of these Asian economies actually use imported gas for power generation. It's also worth noting a couple of things here, that amid the conflict, we've actually been seeing some of these Asian buyers sourcing from the US, and others have turned back to coal. For Southeast Asia, if we can take a look at this chart, that will show you the energy mix for Thailand as well. Worth highlighting, a lot of it, this is based on 2023 data, but a lot of it comes from gas, and a fifth of Thailand's LNG actually comes from Qatar. Also in the Southeast Asian region, you have the likes of Singapore that takes also Qatari gas gas, and I think that accounts for about 2/5 of its imports. So that is a vulnerability, a bit of a pain point for some of these Asian economies. Another thing I would just highlight is as some of these countries step in to help stabilize the fuel markets, you've got to wonder the extent in which this is exerting pressure on public finances as well, Has.
Avril Hong, thank you. The war in Iran is disrupting fuel costs, trade routes and consumer confidence, risking everyday essentials. Lineman Wongnai is a tech startup in Thailand which connects customers and suppliers through food delivery, groceries and ride-hailing. So how does a company built on convenience and speed navigate global instability? Let's get insight from CEO Chinsupakul. Good to have you with us, Yot. I mean, give us a sense of how high energy prices impact, the economics of food delivery as well as logistics.
Yeah, I think today it hasn't, impacted yet as the government is still stabilizing the fuel price. I think there are currently some inconvenience in queuing to get the fuel in Thailand. But so far, I think the oil price hasn't increased locally yet. But when it does increase, which I think it will, we are taking a look closely on how it will impact the fuel cost of our riders. We have more than 100,000 riders working for us. So if that happens, then I think we'll do something to help, the burden of the riders.
So what are some of these contingency plans that may be put in place if oil prices were to rise?
I think we calculated quickly on the back of the paper, maybe it will increase the cost per trip, maybe 2 or 3 baht. So part of that will subsidize to the riders. But then admittedly, I think some of that cost may also impact the consumers as well.
How will that eventually impact business, you think, in terms of demand for those rides if, prices continue to rise?
I think it will impact food delivery a little bit. I think there could be less demands as fuel price increase, and then consumers may see an increase of the delivery fee. But at the same time, the fact that maybe not just fuel prices increase, but other food costs increase as well. People may save costs, stay home, and order more food delivery too.
I'm just wondering whether what's happening in Iran is helping to shape the way you think about the future. Might you be pushing through electric vehicles instead of, motorbikes that rely on fossil fuel?
Of course, I think we have been doing electric vehicles initiative since, I think, 2 years ago. I think we have more than 1,000 cars working for us who are electric vehicles. And at the same time, we have been pushing electric bikes into the market too. So that will definitely help.
And in terms of how current developments, geopolitical developments are impacting the way you look at your IPO, where are you with that?
Yeah, I think we are at the stage of considering different venues. I think Thailand, of course, I think Singapore as well, Hong Kong as well as NASDAQ in the US. I think these are the options that we are considering. I think we are considering not just, of course, geopolitics, but also the liquidity in that market as well as the support that we have from the market too.
So if you're talking about liquidity, then the US market makes sense. That seems to be the most liquid market right now. So would New York be the first choice? Or, what's the thinking on that?
It's one of the preferred choice, I think. Of course, there are other considerations that we have to, consider before we make a decision.
Such as?
Yeah, such as I think the size of the fundraising that we have, fundraising amount, whether or not that makes sense to go into US, whether or not the regulatory environment or geopolitical are actually supportive to us going to the US or not.
You're in Singapore. You're backed by GIC, the sovereign wealth fund in the country. Is there a lot of pressure for you to IPO in Singapore?
There are always some pressure, but at the same time, I think we are an entrepreneur that work with multiple stakeholders, not just one stakeholder. So I think we do what's best for the company, employees, and also shareholders.
So what's the plan for the funds that you will be raising through your IPO?
I think we are, of course, our main business are profitable already. So I think this is more for future businesses, M&As, and other expansion.
And what future businesses are you interested in?
I think we are diversifying from food. I think we are the only player that has, all the deep ecosystem in Thailand, not just food delivery, but also the POS, B2B businesses, and also the fintech in Thailand. So having those deep-rooted ecosystem, I think that's something we are executing. And then with the fundraising, I think we'll do more business in Thailand. I think that's our first choice.
So what exactly would you be investing in? Are you looking for perhaps acquisitions to help you grow and perhaps expand in a more accelerated way?
Yeah, acquisitions are always in the card. I think we have been doing a lot of deals throughout the years to give us opportunities to expand to new businesses. Diversifying from food, such as going into the telepharmacy business, that's something we see as an opportunity. But we also see a very high growth in the grocery business as well, as people are doing more quick commerce in Thailand.
What kind of growth are you anticipating?
We are looking at close to 100% year-on-year growth in the mart or
and
grocery
that's from
business.
A low base.
Yeah, that's from we have grown already 2 times last year, so I think it's just, the base is quite sizable.
And that pace is sustainable going forward. Is there enough demand for you to see that kind of growth going forward?
I think so. I think right now we are mainly operating on the urban cities. I think there are more opportunities to expand to other parts of Thailand.
You talked about how you are intending to expand within Thailand. How about the overseas market? How attractive is it? And what are your considerations when thinking about being a global player as opposed to be a local player?
I think our mission is to help digitalize Thailand. So I think that remains our base case. Expanding overseas are something we keep an eye on and look at. At the same time, we will only execute that if the timing is right, and of course, maybe there's an M&A opportunity open up.
So is it a 10-year horizon before you start looking at expanding overseas?
It could be a 5-year horizon. Yeah.
And how long do you think you'll take to get to where you want to be within the Thai market?
I would say most of the things that we want to do, expanding and diversifying the business, I think within 2 or 3 years, we should see quite a sizable, diversification other than food delivery.
Right now, we're seeing the Thai currency getting impacted by a strong dollar. We're also seeing an economy that is growing rather sluggishly. Is that impacting consumer demand? Have you seen changes in the way consumers consume your services?
It does impact. I think macro always, of course, it's whether we have a tailwind or a headwind on the macro side, it impacts the business a little bit. But food delivery, on-demand services, and payment business that we are doing are still growing strong. I think we expect to grow around 20% year on year to this year. We expect to reach around $660 million USD in revenue this year, with, of course, EBITDA positive since last year. So I think regardless of the macro, I think food delivery, other businesses that we are doing are still going strong, because I think we are working with local consumptions, and also our services are quite attractive to the mass. So it's not expensive to order food delivery with us in Thailand.
Of course, we know that the Thai government is intending to help support consumption, provide incentives for the consumers. Would that provide a boost? Is that what you're anticipating on the back of that?
Yeah, I think we are one of the players and the key players who work closely with the state in order to, of course, boost consumptions in Thailand. Like, for example, Q4 last year, we worked closely with the government on the half-half campaign orคนละครึ่ง campaign that has been quite successful, boosting the GDP to, I think, 2.5% in the Q4. Food delivery, it's a main part of the economy now, and I think we look forward to work even more closely with the government going forward.
It is a sector that is ripe for tech adoption, AI in particular. How are you embracing AI into your business?
We actually have been doing a lot. I would separate it into predictive AI, which are, like, for example, what we use for distribution algorithm, cooking time prediction, recommendations, and stuff like that. We have been working on that since, I think, 5-6 years ago. But now we are also adopting the generative AI, which are more like the large language models in different parts of the business. across both internal workflows, like the customer services, the sales team, the development teams, also externally to our main products. I think on our merchant application, for example, now the merchants can chat with our AI agents in order to, get recommendations, get bundle recommendations, create menus, for example.
It is a technology that's advancing really, really quickly. As you think about AI impacting the business in 3 to 5 years, how do you see AI reshaping your business and the way your riders actually adopt the technology?
It is actually, I don't think anyone can predict what will happen 5 years from now within the AI space.
But the space will continue to get disrupted.
It will continue to get disrupted. I think in all part of the business, I think we'll be ready to actually adopt the changes as it comes. I think not just the rider side, but also consumer side, the merchant side, the rider side, and within the company. I think we are an AI-driven company. We are the fast adopter of the AIs, and then we are also quite confident in, adopting new technology as it comes. Right now, for example, I think there are in other countries, the AI platforms already connect to food delivery, for example, in China. I went to China and people can order food within AI, but actually consumer behavior haven't shifted to that yet. Even though it's available, it takes a while before consumers, shift to that behavior.
People talk about AI and they talk about productivity boost. How much of a productivity boost have you seen so far?
I would say around 30% as I talk to my teams, both on the engineering side and also on the general works. Most people cited around 30% of productivity increase. Of course, that's on the individual level, but at a company level, I think we have to also find other bottlenecks to improve in order to get the end-to-end productivity or throughput of 30%. So I think we are in the process of doing that. For example, our codes are already more than 30% written by AIs already, but the throughput is a bit less than that because there are other bottlenecks along the way. For example, code reviews and also other processes. So I think we have to, improve those processes in order to get the throughput productivity of 30%.
Yo, thank you so much for dropping by. You're Chinsupakul, CEO of Lineman Wongnai. Still to come on Inside, India's only publicly listed gaming company just dropped $100 million on 2 acquisitions. Nazara Technology CEO Nitish Mittersain will be joining us to tell us where India's tech and AI boom is heading. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's just kicked off its trading day. Let's do a check on the initial numbers from the benchmarks in India. This is how it's looking. Of course, the rest of Asia under a lot of pressure. India, too, is under pressure. The Sensex currently down by almost 2%. Remember that this is one country that's dependent on imported oil, and with oil surging in excess of $100 a barrel, we're looking at 110. Actually, for Brent, India is looking at a lot of pain there. The Nifty index down by about 1.9%. One stock we're actually tracking is HDFC. Now, HDFC part-time chairman Atanu Chakraborty has resigned. He cited ethical differences. Chakraborty wrote in his resignation letter that certain happenings and practices within the bank are not in congruence with his personal values as well as ethics. We have HDFC Bank currently slumping about 5% as we speak. Now, the regulator has approved the appointment of Keki Mistry as interim chairman for 3 months starting March 19th. Again, HDFC slumping about 5% right now. Let's have a look at the shares of Nazara Technologies after the Indian video game company announced its UK subsidiary is acquiring controlling stakes in social gaming firm Blue Tile Games and Best Play Systems. It's paying just over $100 million for the acquisition. Well, Nazara is India's only publicly listed gaming company with key businesses including Kidopia, World Cricket Championship, and Sportskeeda. It also runs offline gaming ventures, Funky Monkeys and Smash Entertainment. Joining us now is CEO Nitish Mittersain. Nitish, good to have you with us. First of all, talk to us about why you can justify that $100 million price tag.
No, sure. The two companies that we have acquired, which is Blue Tile Games and Best Play, are a very unique combination of very high quality AI-driven games. There's 17 active games today. These games have generated 375 million downloads till date. And the company has 22 million monthly active users, generated in 2025 $153 million of revenue, with close to $28 million of EBITDA, strong cash flows. So I think a very, very strong team, and we see a lot of potential for growth. Also, uniquely, they have this proprietary reward platform, which they can use for cross-promotion, user discovery, and monetization. So their reliance on just marketing dollars to drive business and users is significantly coming down, and that can also help the rest of the Nazara ecosystem going forward. So I think keeping these things in mind and keeping the team's focus on AI-driven development to be able to bring new games to the market very quickly attracted us to this acquisition, and I think it should be a very good long-term bet for us.
In terms of synergies, what synergies do you see in the first 12 months?
Yes, I think two important synergies. Like I said, the Best Play platform should allow Nazara to launch its existing portfolio of games and open up a new source of user discovery. I think that would be very interesting for us. And the second is the AI adoption. We are already at Nazara, moving forward with AI adoption across multiple verticals, I would say: user acquisition, data analytics, how games are made, how users are engaged, etc. But we believe with Best Play's technology and know-how, we could actually fast-track the AI adoption across the group very quickly.
Nitish, would you say that this acquisition would allow the company to compete with your global peers more aggressively?
Yes, absolutely. We believe Nazara is emerging as a global gaming platform, the first one really from India. And as we continue to acquire businesses, integrate and synergize them globally, we think we will be a global player to contend with.
How about in terms of further acquisitions? Might you be looking at more M&As to help you accelerate that growth?
Yes, I think Nazara has been active in the M&A space for the last 7-8 years. So I would say we've kind of learned our way along, honed our skills, in that on that front. And we believe that the opportunities for us today are immense. Global markets offer attractive valuations, strong propensity for consumers to pay. And it's a very interesting opportunity for Nazara to scale in a very profitable manner, with strong generating cash flow assets. So I think we will continue to do that. This, of course, the current acquisition of Blue Tile and Best Play is the largest one we've really done globally out of India. This is actually acquired by Nazara UK, 100% subsidiary of ours in the UK. And we will double down going forward as well.
Gaming, of course, is an increasingly competitive space. Where are you with talent and talent retention?
Yes. I mean, talent, of course, is the number one priority for us. And one of the things that we're really focusing on is upskilling our talent with AI, because that allows us to deliver a lot more content with the same, number of people that we have, who are able to be a lot more productive. And I think that can be a game changer, both in terms of how we engage our customers and also could help us in a lot of margin expansion going forward.
Nitin, throughout the show, we've been talking about geopolitical concerns and, of course, the surge in oil prices. This is also an industry, a sector that is pretty much exposed to high energy costs. What impact are you seeing on the business right now?
I mean, obviously, what is going on is very unfortunate, and we haven't seen any impact directly in our business at this point of time. But we will, keep a close eye on it.
But how about energy for data centers, cloud compute, network bandwidth? I mean, might all those be impacted at some point? And, where is that threshold that you're looking at?
Yes, it's, as you would appreciate, it's a very fast evolving, situation. And we really haven't, or we are still trying to figure out how this may translate into any impact, if at all, in, our business or related areas. So I think over the next few weeks, we will have more clarity if there is any impact at all. But at this point of time, we don't see any impact.
When you take a look at the business, how much of your cost base is either directly or indirectly linked to energy?
I would say our biggest cost base related to energy would just be, the AWS and the hosting parts of our business. So I would not say there's a lot of dependency per se.
Are you willing to do some cost cuts if energy prices remain elevated? What are some of the contingency plans that you may be looking at?
Yes. Nazara has always focused very much on its, operating cash flows. And if, any requirements do arise, we will take what is necessary to protect our business as we go along. We're always flexible and we will do the right thing for the business.
What indicators are you looking out for to suggest perhaps a slowdown in consumption? We know that consumption of gaming in India has been pretty resilient, but are there indicators you're tracking?
Yes, I think for us, the percentage of paying customers or subscribers is an important, indication whether there's consumption slowdown. We usually don't see slowdown in terms of people downloading games and playing games. But in a difficult environment, you may see, a drop in the propensity to pay or an increase in churn rates, etc. So those are the KPIs we would keep a close watch on. Again, like I said, we haven't seen any change in our KPIs or our business at this point of time, but we continue to keep a close watch on it on a daily basis.
Nitish, thank you. Nitish Mittersain, CEO of Nazara Technologies. Still ahead, the Fed and the BOJ holding rates steady today as the Iran war clouds the economic outlook with soaring oil prices. Jefferies' Christopher Wood will be helping us to navigate volatile markets next. Plus, Middle East expert James Dorsey will be weighing in on whether shipping in the Strait of Hormuz can be protected. More to come in our next hour of insights. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Let's take another look at how markets are faring. Avril is here with the very latest. Avril.
Yeah, Has, we're seeing a down day across Asia stocks after some stabilization earlier in the week. You have some idiosyncrasies with the Indian market following HDFC, Tencent on the Hang Seng, but I think the focus is squarely on energy, oil, the Qatari extent of damage we're seeing potentially on last Rafah, and investors are assessing the extent in which that is going to fuel the energy shock and the impact ensuing on inflation. For now, you are seeing the Kospi also down at one point today. Worth highlighting, this is following on from the 3-session rebound that it declined by the most since last Monday. So you do see that bit of risk off in Asia stocks. Now, we are also watching from the BOJ, watching for the presser from Ueda-san, but early indications already, the talk about oil prices, that is worth noting, and it sounds like a hawkish hold from the Japanese central bank through the board as well. Certainly that's what came through from the Federal Reserve, and that caused a massive repricing, particularly in the front end of treasuries. You saw those yields spiking on the 2-year as well. Traders now pricing out those Fed rate cuts for the year, and this is what you're seeing in the curve. Has.
Avril, thank you. Well, joining us now is Christopher Wood, Global Head of Equity Strategy at Jefferies. He's also been the author of the weekly Greed and Fear report since 1996. Chris, good to have you with us. What do you make of the reaction we're seeing in markets right now, in equity markets right now, on the back of developments overnight?
Right. Well, I've been at the Jefferies Hong Kong conference this week, and so most investors I've talked to have been amazed how little the markets have been reacting to what is obviously major geopolitical events. And the explanation of most, including my own explanation, is that markets have become used in recent years to seeing these geopolitical events as buying opportunities. And I think that's the explanation for the remarkable complacency. But that clearly means that the longer this conflict goes on, the bigger the risk that it hits markets. And the fact that Donald Trump has delayed his trip to China, is a clear indication that he's not doing, would seem to suggest anyway, that he's not doing, going to back off or do a taco anytime soon.
Brent crude currently at $112, and it's been above $100 for several days now. How high do oil prices have to be, and for how long before you see perhaps a structural re-rating of the U.S. market in particular?
Why would it re-rate? Re-rate.
Is there?
My big, in the short term, this conflict will be probably a relative positive for the U.S. market relative to more energy-dependent countries. I agree with that, and it's put a short-term bid for the U.S. dollar. But my own personal opinion, if you want to own one stock, let's say this conflict goes on for the rest of the year. Let's say there's a massive increase in energy prices across the globe, and these rising energy prices fundamentally damage GDP growth globally. Then, in my view, the best market to own, equity market to own in the world during such a period is the Chinese mainland market.
Why?
Because the Chinese mainland market will be least geared to those negative developments. China has a decent supply of oil reserves, and China has made dramatic advances in renewable energy, which means that China in reality has almost unlimited access to cheap power. And this has been a major development in China in contrast to the US, where in the US you see this major bottleneck on electricity power generation, which is causing this huge ramp up in trying to invest in energy in the US, whereas in China you already have an incredible huge surge in power generation based on dramatic improvements in renewable energy, improvements in battery storage technology, which means, based on what I've been hearing in recent months, that solar has now become cheaper than coal in China. So China is light years away ahead of the US in terms of energy, and energy is probably the key sector globally.
And Chris, when you talk about China, would you say that you buy the dip, and what in particular is looking attractive in China?
Well, I'm viewing the Chinese stock market as in a slow bull market, which is also what the Chinese government wants to achieve. Basically, the market bottomed in of about September, October 24 at about 7 times earnings when we were fully discounting the deflation. Since then, we've basically been in a rising trend, but the Chinese government has been very anxious to avoid what's happened to all previous Chinese bull markets, which ended up in boom-bust cycles. So you're seeing ongoing pressure on Chinese companies to boost dividend payout ratios, to buy back shares, and very importantly in the mainland market, they seek to be preventing an explosion in supply in terms of IPOs. And you also had the national team playing a role. So I believe in January this year, to cool down the market, the national team sold about half their ETF holdings, so I'm told. And, now that the market then subsequently corrected, I was in China last week, I heard that the national team has started buying again. So I buy into this sort of slow bull market narrative. Meanwhile, in Hong Kong, which is obviously appendage to the Chinese story, that's where you're going to get the more and more evidence of Chinese companies listing in Hong Kong, which are already listed in the mainland. And in terms of the Chinese economy, we are, yep.
Go ahead.
No, just in terms of the Chinese economy, clearly we've been in deflation for many quarters. Nominal growth's been lower than real growth. But one good thing right now is CPI and PPI has started to get less negative. CPI has gone marginally positive. And actually one perverse positive side effect of this ongoing Iran conflict, if it continues, is it's likely to cause PPI to go positive. And in my experience, mainland fund managers are very focused on PPI, and PPI going positive will be viewed bullishly in the domestic Chinese market and will raise hopes that deflation is ending in China.
Chris, Chris, if the war persists, if oil prices remain elevated in excess of $100 a barrel, how should investors be positioning to hedge stagflation, for instance?
Well, yeah, I mean, equities, I think the best way to position is to own Chinese stocks. Otherwise, clearly, you have to continue to own energy stocks. So to me, those are the two single best hedges. Gold is okay too. I've been very bullish on gold, but my short-term, my tactical view on gold, which I said at my presentation this week's conference, is I believe gold has entered a consolidation period. The signal that gold has peaked for now is that it did not make a new high on the outbreak of this conflict. So I kind of mentally view gold as in a trading range between 4.5 and 5.5. And I think that may extend for a period. Meanwhile, the gold mining stocks, which have performed incredibly over the past year, will also be in a consolidation mode because the higher energy costs will impact their margin. So in my view, best way to hedge this is to own energy stocks and, in terms of geographical allocation, be as overweight China as you can afford to be.
How much gold should you be holding? Should you be holding more gold in your portfolio?
Oh, no, well, I've been owning gold for years. So gold's, I put a target of 3,500 on gold back in 2002. So to me, gold's finally reached the levels it should have reached years ago. Long-term gold can go much higher. We are moving to a de facto gold standard globally because based on current gold prices, central banks globally now have more in gold than they own in U.S. Treasury bonds. So that's clear evidence that no one's announced this, it's just a de facto move to a gold standard because central banks have been buying gold ever since they were shocked by the move to freeze Russia's foreign exchange reserves back in early 2022 when the Ukraine issue blew up. So yeah, the central banks have driven this gold bull market.
You talked about how you've been surprised by the complacency in the market. If all the risks are being priced in, where should markets actually be? How should they be looking at? What levels should they be at?
Well, I would look at this more like at the VIX. So the VIX, when I last checked it, was well below where it was both in the pandemic and in the tariff taper tantrum. And so we can definitely get back to those levels on the VIX if this thing gets worse. But the key issue really is, the key issue right now with this is, are the US going to put troops on the ground? I think markets have been hoping for a TACO. And so far, obviously, the TACO has not happened. And so the markets are finally waking up to the risk of more escalation. And what's prompted this scare overnight is simply Iran, I think, responded by the attack on this energy facility because of the attack on its own facility. So none of this should be any surprise to anybody. The Iranians made it extremely clear before this whole thing started that if they were attacked, they would view it as an existential risk, and it would be all-out war. And they made it very clear they would attack U.S. military bases in the Gulf, regardless of the collateral damage. So that's what's been happening.
We saw the Fed standing pat overnight. Do you think high oil prices would eventually force the Fed to start tightening?
Well, I think, yes, at some point they'll have to acknowledge that, but I'm not surprised they stood pat over the night. I think more important than the Fed is the Treasury bond market. So long as the Treasury bond market remains well behaved, then the Fed will not be forced into tightening. So I think we need to keep an eye on the 10-year Treasury bond. But for now, the 10-year has been relatively well behaved. I think that the central bank where monetary policy is now important for markets is the Bank of Japan. The Bank of Japan's behind the curve in tightening, and the BOJ should, but I doubt it will, should take advantage of the excuse of this war to do what it should have already done, and that is raise rates in Japan. If they do not raise rates this week, they're increasing the risk that the yen breaks through the key technical level of 160 against the dollar. How
soon do you think that will happen? Because the BOJ did stand pat today.
Well, they made the wrong move. If the BOJ should have raised rates without telling the market, that would have been very positive. It would have caused the Japanese bond market to rally and the yen to stabilize. So I think that's a major error on their part. I think they should have raised rates even if this war wasn't happening.
Chris, hang tight. Chris Wood from Jefferies is sticking around, still ahead. Tencent says it's doubling its AI spending this year, but Bloomberg Intelligence says that could strangle profits. Analysis just ahead. This is Bloomberg. Welcome back. You're watching Insight, and here's a look at how Tencent shares performed in Hong Kong's morning session after the tech giant said it plans to at least double investments in AI this year to $5.2 billion. Bloomberg Intelligence thinks this could put profits at risk. Senior analyst Robert Lee is with us. First of all, Rob, take us through, what transpired.
Okay, well, the reported numbers themselves were solid, but almost, exactly in line with expectations. So no great concern there. That's all in the rearview mirror. As you can see, with the stock down something like 5.5% as we speak in the Hong Kong market, big question is what has prompted that? I would say a number of things, and also tied into the messaging that the company gave or the way they delivered their message last night. Because on the earnings call, they really started on the back foot and on the defensive, although they didn't say explicitly and directly. I think they started with a very defensive update, trying to stress their defensive qualities and bat away any potential concerns on this SaaS apocalypse. So I think what they said was correct and justified, but it set the whole earnings call in a somewhat defensive, negative tone. And then subsequently, they talked about doubling their AI investment over the course of the next year, which again is totally understandable given the strong demand in agentic AI. But there is no real timeline on when that investment is going to deliver a return. And I think, famously, Tencent is well respected as a very conservative, broad-based company that has a very mature view on things. I would say, in contrast to their peer Alibaba, which is a bit more gung-ho in their approach to AI. Tencent's AI strategy today has been far more internally focused to drive internal synergies, which has, in my view, been exactly the right strategy. But now they're taking a shift in strategy. They're investing in a more speculative basis. They're also cutting back on their share buyback to partially fund that. These are messages that the market in this current environment is not going to take particularly positively, and hence you're getting the profit taking today.
And speaking of Baba, it is out with earnings later today. What can be expected from that report?
Okay, as we know, Baba stock has also been weak over the last months. There was a lot of hype surrounding their cloud business. I think that will still catch the headlines to some degree, but I come back to the same point. Where's the return on investment? Because their capex has approximately trebled over the last 12 to 18 months or so, whereas just looking at the incremental change in quarterly profit in their cloud division, the increase is around $130 million US. So the capex has trebled to about 18 to 19 billion a year, yet the increase in quarterly profit in that division is just over $100. That is a pretty weak, poor return on investment. So I think that will still catch headlines. Whether it impacts the share price or not remains to be seen. But the core of Alibaba's business is e-commerce. There's a lot of pricing pressure there. There are price wars. There's also a price war in the food delivery sector. That's the core of their business. That's the main earnings driver for them. That will remain under sustained pressure. And as we've seen, consensus numbers have come back significantly on Alibaba over the last 6 months or so. That's one of the main reasons the stock's been such a weak performer. So I think despite the positivity on AI, the reality is their core e-commerce business will remain under pressure for some considerable period.
Rob Lee, always a pleasure. Bloomberg Intelligence Senior Analyst Robert Lee there. Now, Chris Wood, Global Head of Equity Strategy at Jefferies, is back with us. Chris, when we hear Rob talk about return on investment, would Baba, would Tencent be a buy for you?
Well, yeah, in the big picture, there's a very valid points being made. But where I'm really looking on a return on investment on AI capex, the real issue there, in my view, is the U.S. hyperscalers, because they're spending a lot more money than their Chinese counterparts. And the market has started to question those returns in the most recent earnings season. So I think, questioning on returns on AI capex applies with the Chinese companies, but applies even more in the US, and it's more important globally from a US standpoint, because obviously the hyperscalers are a huge part of the US stock market. So I think, returns on whether people are going to get...
Right.
Sorry?
So China's the place to play AI.
Well, my personal view is that there's a growing risk that AI capex may peak in the US this year, where all the evidence is that AI capex in China will continue to rise, albeit from a lower level, as we've seen Tencent's just upping it. But in both cases, there is a separate question of whether they're going to make a return from that capex. So the way I look at it, we started this AI capital capex arms race back at the beginning of 23. In the US, we're now 3 years into it. So from here on in, the market's going to start asking harder questions of people are going to make money from this capex.
What will make you turn bullish on US AI again? What would that take?
Well, no. Well, I'm not. Yeah, no. What I've been saying over the last 3 years is to own the picks and shovels plays who are getting paid for the capex, as opposed to owning the companies or spending the money. So from that point of view, the best picks and shovels play has been Nvidia, but I think I took that out of my portfolio late last year simply because it's already got record profit margins. This year, what's continued to do well has been the Asian supply chain, semiconductors. Obviously, that's TSMC, Hynix, Samsung. But the question is, if the more the market questions the AI capex, and that process has begun, the more the market might become concerned that the capex may be cut, and that would mark the peak in the semiconductor stocks. In China, it's a bit different. The AI capex is growing from a lower level. So personally, I think one of the best things to own in China are the picks and shovels plays. In China, the Chinese equivalents of companies like Nvidia. But the problem for many foreign investors is, I believe I'm right, many of these stocks are sanctioned by the US.
Right. Chris, you're also expecting capital to rotate from markets like Taiwan and Korea to India. Why is that?
Well, no, that's not happening yet. That will only happen if people become convinced that the semiconductor stocks have peaked, which is not yet the case. So right now, the only thing that matters for global emerging market investors this year from a relative basis is when to top tick the semiconductor stocks in Taiwan and Korea. And when that happens, there will be rotation into India. But if the semiconductor stocks are rallying all year, the rotation to India will not happen. My personal view is that the relative outperformance of Korea and Taiwan has peaked, even if these stocks may still be going up. I think the relative has peaked.
Speaking of India, Chris, we have a scoop from Bloomberg. India's net forward dollar sales to aid the weakening rupee is now nearing $100 billion. It is using a key tool to defend that currency, which is at an all-time low against the dollar right now. Not surprising, given how India is very reliant on imported oil. Chris, your take on what we're seeing in terms of the sentiment in India. We know that global investors have been making an exit because of its situation. That weakening currency is not helping either.
No, I completely agree. No, the weakening of the rupee last year was a surprise to me. I think they made a mistake letting the currency weaken that much. I think they did it, the central bank, to help the export sector because they had those huge tariffs from America. But then that was a mistake in my view because the Indian economy at the end of the day is domestic demand driven, and that weakening of the rupee beyond the key psychological 90 level was a negative shock for Indian corporates. corporates who were not expecting it, and it also led to big speculation in gold. We had huge gold imports in India in the month of January. So that was already happening, but then we've had this double whammy of what's going on in Iran, in the Middle East, and that's clearly caused more rupee weakness. So right now, no one's going to be in any hurry to rotate into India. As I say, for money to go into India, you really need people to be convinced that this semiconductor thing has peaked. Personally, I believe India is still a good long-term structural story. Foreigners have sold a huge amount of India, but the domestic mutual fund flows keep coming in India.
Chris, today we had the HDFC chair quitting over ethics clash, and that's raising a lot of concerns. What's your take on these kinds of developments in India?
What's happened? I know nothing. What happened? Sorry?
Right. HDFC chair has quit because of a clash in terms of ethics, he says. Any comments from you on that development?
No, I know nothing about that. The risk for the Indian domestic market is that the Indian domestic market has benefited in the last few years from incredibly strong domestic mutual fund inflows. So if for any reason those inflows suddenly stopped, the market will be vulnerable.
Chris, we have to leave it there. Thank you so much. Chris Wood, Global Head of Equity Strategy at Jefferies. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The Carlyle Group's Jeff Currie says oil markets have not fully priced in the supply shock from the war in Iran. He also told us the lifting of sanctions on Russian crude will support the surge in Brent and WTI.
The bigger factor that was likely driving WTI and Brent and staying lower is the price of Urals, Russian crude oil. It's rallied $65, $70 a barrel once they took off the sanctions. So WTI and Brent were the high-cost barrels. The Russian was the cheap. What happened? You closed that gap. And now that you've closed that gap, you don't have any more spare barrels in the system, and this rest of the complex likely to start to rally. I go back to the point that John started with is, we're dealing with an enormous supply shock. And by the way, the supply shock is almost equal to the demand shock during COVID. And we know what that did to global supply chains. So I think at $100 a barrel, this thing's mispriced. Even against the physical market.
There is a sense, though, that this time is a bit different than, say, the 1970s in terms of the world's reliance on oil, especially China, how much they've diversified to electric vehicles, to nuclear energy, and other places as well. How much do you think that is going to be the growing trend, to diversify the sources of energy in myriad ways beyond what we were doing, even during the so-called Green Revolution, as people try to avoid these types of shocks?
Well, I absolutely argue that the renewables, nuclear power, are born out of the 1973 energy crisis, and this is going to unleash an enormous amount of investment into renewables, nuclear power, and other localized energy sources. The problem, though, is we call this the new dual order. The problem is that we haven't got to that transition where we have electrified everything, localized it, and the type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table. Or you go from LPGs to synthetic fibers to cotton. You switch out of soybeans and corn into cotton. By the way, I think the best sector to try to get value in right now would be agriculture because it hasn't priced it in.
Jeff, when it comes to barrels coming off the market, this came from an industry consultant in terms of China. They're looking at potentially a drawdown in commercial and operational stockpiles amounting to as much as 1 million barrels a day. That can happen over the next 4 to 6 weeks. What would that mean for the price of crude?
I think the key point is once you exhaust those inventories, there's nothing left. Think about it this way. You have demand up here, supply down here. Once those inventories are exhausted, boom, you have to bring demand down in line with supply.
And that was Carlyle Chief Energy Strategist Jeff Currie speaking to Bloomberg Surveillance. President Trump has moved to distance the U.S. from the attacks on Iran's South Pars gas facility, saying the strikes were carried out by Israel without Washington's knowledge. In a social media post, he's promised to hold back his partner in the conflict from further attacks on the Iranian site, but he also warned any further retaliation by Tehran on Qatar would force the U.S. to step in and destroy the facility. Qatar LNG earlier reported that an Iranian strike caused extensive damage at the Ras Laffan industrial city, which houses the world's largest LNG export plant. Let's get more on this with our reporter, Dan Murtaugh. Dan, talk to us about the extent of the damage that was seen.
Yeah, so Qatar LNG said that there were 2 strikes overnight. One late Wednesday night, Qatar time, which damaged a gas-to-liquids facility there at Ras Laffan. And then a second strike came in Thursday morning. That hit the LNG plant, causing some fires and causing extensive damage there on LNG equipment. The fires have since been suppressed, so they're not burning anymore. But the company is still probably assessing how much damage is there at the LNG plant right now. The market is very eagerly awaiting to hear how bad it is and how long it's going to take to repair.
And of course, we heard from President Trump himself saying that he will not be attacking Iranian energy facilities anymore. That is actually reported by the Wall Street Journal. What do we know, and how comforting is this to the market?
I mean, right now it's not particularly comforting, I don't think. I mean, we've gone from a place where most of the impacts on the energy market of the war in Iran up until now centered on the Strait of Hormuz. It was, Iran was blocking that, so all the energy that was inside in Qatar, in Kuwait, and Saudi Arabia, and Iraq, that it wasn't getting out, and so that was the problem. But now this new escalation that started hitting energy facilities. Now we're not talking about, okay, once the strait is open, we'll get things rolling again in a matter of weeks. When we're talking damage to these facilities, I mean, we're talking now potentially a matter of months that production could be offline. And we won't know the details for a little while here, but traders are going to start pricing in that risk of longer and larger supply outages, and that's going to be a big problem for the global economy.
Dan Murtaugh, Bloomberg reporter, thank you so much for that. Our next guest is a Middle East expert with first-hand experience of being aboard a U.S. naval escort mission in the Strait of Hormuz back in the 1980s Iran-Iraq War. Let's bring in James Dorsey, Adjunct Senior Fellow at the S. Rajaratnam School of International Studies. James, good to have you with us. I mean, we have both sides now attacking energy facilities. What does it tell us about, the strategic calculus that they both hold right now?
I think we're seeing different calculi, if you wish. On the one hand, the United States has refrained until now from attacking Iran's oil and gas facilities, basically arguing that if they did so, they would set back substantially Iran's ability to recover and rebuild once the war is over. For the United States, the goal is at this point, and for Donald Trump in particular, to find an exit strategy. And his problem is that escalation of the war is his only possible exit strategy, ultimately. The Iranians want to raise the price in the belief that they have a much greater ability to absorb pain, and that if they can have the longer breath in doing so, they will force the United States, under pressure from the Gulf states, from the international community, from the energy markets, to bring an end to this war. Israel's goal is very different. Israel preferably would want to see regime change, but in the absence of that, wants to see Iran militarily, economically, and politically weakened for years to come.
James, fair to say there is no exit strategy right now. It's hard to see an off-ramp. Is it also safe to say that, when President Trump predicted it would be a 4 to 5 week war, this isn't going to end anytime soon?
Trump miscalculated from beginning to start. He underestimated Iran's resilience, its willingness to resist, its regime cohesion. He expected that the marshalling of an armada in the vicinity of Iran would persuade Iran to capitulate to his demands. something which Iran has clearly refused. The problem now is that the Strait of Hormuz in many ways has become the focal point. Trump, in order to credibly exit the war and declare victory, needs to ensure that shipping through the Gulf is free and safe. And to do so, he needs to militarily escalate, potentially putting a limited number of boots on the ground.
Right now, the Strait of Hormuz is an asymmetric weapon for Iran. Is it sustainable, you think?
As long as Iran is capable of laying mines, firing missiles, launching drones, it's sustainable. It doesn't take much to effectively intimidate shipping and prevent it from going through. All it takes is one missile or one mine or one drone.
The thing is, the U.S. keeps saying this is a weakened Iran. How is it able to still counter the attacks of both the U.S. and Israel? I mean, it has the capacity, even right now, to carry out long-range attacks.
There's no doubt that Iran has been weakened by the 2.5 weeks of war and the pummeling of its military facilities and various other targets. Having said that, Iran may be down, but it's not out. And that's the problem. With other words, even if it has planned for this, it has planned for successions, it has planned for successions of the successors in the knowledge that they would be targeted. And what we've seen until now with the killing on the first day of the war of the supreme leader, the killings in the last 48 hours in Iran, it's able to sustain those losses.
James, you talked earlier about how the Straits of Hormuz is critical for the U.S. to declare victory. The U.S., of course, has talked about naval escorts in the Straits of Hormuz. How realistic is that? How difficult is it to protect the Strait of Hormuz?
It's very difficult. First of all, to escort vessels through the Strait of Hormuz, you need to have control of the strait. Iran doesn't have control of the strait. The last time that the United States escorted vessels in Gulf waters was in 1987, when they were escorting reflagged Kuwaiti vessels. The first vessel that they escorted was the MV Bridgeton, at the time one of the world's largest oil tankers. I stood on the bridge of the USS Fox, 50 meters away from the Bridgeton when it hit a mine. This is a 413,000-ton deadweight vessel. It can sustain damage from a mine. It was able, on its own steam, to make its way to Dubai for repairs. Had the USS Fox, an 8,000-ton vessel, hit the mine, you would have seen far more severe damage to the vessel and potentially casualties.
How much is needed to provide protection? I mean, some reports suggest that you need 8 to 10 destroyers to do that, and there is very little capacity to sustain something like that.
You need several destroyers, and the USS Fox was one of several with the Bridgeton. But you also need to control the environment. So what that means at the moment is for the United States to be able to wrest control of the Strait of Hormuz from Iran, it has to take territory. That territory could be on the Iranian mainland, the most risky way of doing it, along the shorelines of the Strait of Hormuz. But it could also involve, for example, occupation of islands that Iran controls at this moment, but are claimed territorially by the United Arab Emirates at the mouth of the Strait of Hormuz. It has various options, but whatever it does is going to involve escalated military activity and potentially, as mentioned, troops on the ground.
Can the U.S. provide protection without the help from its allies like Europe? Because when you talk about the shoreline, we're talking about a 400-mile shoreline.
essentially, in theory, it could. The problem for the United States is that it's stretched. If it were to start escorting vessels through the Strait of Hormuz, it would have to withdraw those vessels, presumably from the armada that is being used to attack Iran. Or it has to further remove ships from other parts of the world, particularly Asia, to the Middle East. And that's going to take time. So in that sense, U.S. options are limited without the help of its allies, whether Asian or European.
A lot is at stake, of course, for U.S. allies like the Europeans, like the Asians, and yet they have refused to come and answer the call of President Trump. Why do you think that is so? Are they just snubbing President Trump because they were not consulted, or are the risks way too high for them?
I think this is significant. It's the first time that U.S. allies and partners have stood up to Trump. Keep in mind that Trump, in the last 14 months since returning to the Oval Office, has in many ways reshaped international relations. He's put himself at the center of it. Countries tried to avoid getting on his bad side or tried to ensure that they were on his good side. That's not happening now. So this is really crucial. And I think the reasons for it are multifold. We've seen in the last month, since Trump returned to the White House, claims for territory and threats of military action in the case of NATO ally Denmark. We've seen the imposition of basically arbitrary tariffs. We've seen his vacillating attitude towards NATO and towards Ukraine. So there are lots of reasons why the U.S. allies may not want to now help him out of the corner he's boxed himself into.
Right. James, there are some reports also suggesting that even if we have escorts on the Straits of Hormuz, only 10% of capacity of shipping will return. Is that a fair assumption, or what are we looking at if, escorts are being mobilized on the Straits of Hormuz?
I think it's going to depend on how those escorts are mobilized. With other words, if it's just escorts with Iran retaining control of the Strait of Hormuz, then we're going to not see that many ships going through. Of course, also because there's a limited number, just physically, of vessels that the United States can escort. It doesn't have the ships to escort the 138 or 140 vessels that, prior to the war, transited the Strait of Hormuz. So it really depends on the environment in which the United States were to choose escorts of vessels going through the strait.
And James, taking a look at the impact that this Iran war is having on shipping through the Strait of Hormuz, is the Strait of Hormuz still a viable route for the transportation of what is a very valuable commodity to the world?
At this point, there's not a lot of alternative. Trying to evade the Strait of Hormuz would mean investing enormous amounts of money in alternative infrastructure, pipelines, and so on. And that's not something that's going to happen in the short term. So as a matter of principle, there really is no alternative. On top of that, of course, those countries like China, for example, that rely on Iranian oil exports, those exports by definition are going to be going through the Strait of Hormuz.
James, before we let you go, we've been talking about how, everything depends on the duration of this war. I know it's really hard to predict, but given your experience and how you've been looking at the situation for a very long time, how long do you think this war might last?
I'm not going to try and look in a crystal ball and predict that. I think what you've got to realize is that at this point, none of the combatants is interested in an end of the war for different reasons, but nonetheless. And as long as you don't have countries interested in trying to find a way out of this conflict is going to continue.
James Dorsey, Adjunct Senior Fellow at RSIS, we thank you so much for your assessment today. Still to come, our exclusive conversation with AIA Group CFO Garth Jones as the insurer announces a $1.7 billion share buyback. This is Bloomberg. Welcome back. You're watching Inside. AIA Group has announced a $1.7 billion share buyback after new business value rose 17% last year, meeting analyst expectations. Group CFO Garth Jones told us the insurer is seeing strong momentum in Chinese business growth despite challenges to Asia's largest economy.
Our business is a very long-term business, and it plays to the real needs of people. So we see fluctuations in markets. We see sentiment shift from positive to negative. What we continue to see through the cycles is a strong demand for our products and services because they meet the real needs of people. Our protection and long-term savings products really go to the heart of what people need for their retirement, to protect them for their health care and so on. So we still see continued demand. You see that demand coming through in the very strongly excellent results we've posted today. We see good momentum in the business, and we're very confident about the future.
There's also, of course, private credit as an area to worry about as well. Does the business have any exposure there?
We have a very small exposure. It's about 2% of our assets are invested in private credit. The investment is with the big private credit investor companies. What we see is that the majority of that investment is in senior structured direct lending. We think it's a very attractive asset class if managed very properly. Obviously, we have a very disciplined investment function. We're very focused on credit risk in particular and look through all our exposures. We're very comfortable with our exposure, and as I say, 2% of the overall portfolio of assets.
When you have another war raging in Iran and you have more uncertainty about where global rates are headed, and there seems to be a sort of a narrative that those rate cuts might get delayed, what is the impact when it comes to the uptake of your products and demand out there? Because a lot of these products could also potentially compete with other financial goods out there with high bond yields now being a norm.
Ours is a long-term business. We see fluctuations from time to time. Clearly on the balance sheet side, we have a very disciplined asset liability management. And we update our products regularly to meet the varying needs of customers as they evolve, particularly for the long-term pensions products. So with that, we continue to see the demand coming. We see the momentum in the business, and we can see that the track record that we have over many years is continuing. And that track record has been built through cycles. We've seen interest rates shift, we've seen curves shift, but that demand continues throughout.
Many Asian economies, of course, are energy importers. Do you see any of that macro stress coming from the Iran crisis leading to some downside pressure? And what are your expectations for that positive momentum that you talked about to actually continue into the uncertainties of this year?
We have a very strong balance sheet, so from that perspective, we're very secure. From a demand perspective and a growth perspective, we see that the technology that we've used, that we've implemented, has increased the productivity of the agency force, which is 73% of our sales are through the agency force. You saw that grow 13% last year. You see that the partnership business through banks and brokers grew by 22%. What we have is a situation where the fundamental structural drivers of our growth in Asia are still intact. The consumer, the affluent consumer, still has funds, and we see our products as a long-term savings products as a good place to stewardship those funds for good returns to customers. People also have protection needs on a continuing basis, regardless of the macroeconomic environment.
AIA Group CFO Garth Jones speaking exclusively to Bloomberg's Heidi Stroud-Watts and Sherry Yon. Before we go, here's a look at our guests for tomorrow. Bank of Singapore's Jean Chia and Equity Group's Nuruddin Al-Hamouri will be sharing their investment strategies amid the Middle East crisis, plus Motilal Oswal's Ramdeo Agrawal on whether it's time to buy the dip in Indian equities. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.